What's up, guys? Welcome back to the channel. Welcome back to another video. If you're stopping by the channel for the first time, please consider subscribing to my channel. And while you're at it, smash that like button for me. I really would appreciate it. Also, hit that post notification bell so that you're notified every time I upload a new video. Be careful down in the comment section of the videos. A lot of spam, a lot of scammers. I will never ask you to contact me by WhatsApp or Telegram. I also do not invest money for my subscribers, so please be careful. Don't get yourself scammed. If you want up to 12 free stocks, Webull is going to give you up to 12 free stocks when you open a new Webull brokerage account. Put any amount of money in that brokerage account. They're going to give you up to 12 free stocks for just trying out their brokerage app. Those 12 free stocks will be worth up to $30,600. There's a link down in the description box of this video. Click on that Webull link. Open up that new Webull brokerage account today. Go get that free stock. Go get that free money. The Federal Reserve, guys, is in charge of monetary policy here in the United States. They also are in charge of keeping price stability in our economy here in the United States. And right now, that is their number one item on their agenda in their May 2nd and May 3rd meeting, which is just right around the corner. We already know they've been fighting with inflation for the last year and a half. In January of 2022, that's when their fight with inflation officially started. And they've had at least 9 rate hikes over that year and a half in order to fight inflation. In June of 2022, inflation hit 9%, guys, which was the highest it's been in about 40 years. So the Federal Reserve aggressively started increasing short-term interest rates in 2022. See, the Fed funds rate, AKA short-term interest rates, in January of 2022 was 0. And what is the Fed funds rate? Well, that's the rate that banks borrow money between each other. The Fed raised the Fed funds rate from 0 to 5% in a year and a half, guys. But it's worked. Because inflation from its peak of 9% is currently 5%. So it definitely worked. The Fed has a decision to make in their May 2nd, May 3rd meeting, whether they're going to continue to increase short-term interest rates by another 25 basis points, or do they just put a pause on it and not increase? Personally, I think they will increase. And I think the market believes they will increase by 25 basis points because if you remember, that was their mandate for 2023, was to increase interest rates by another 75 basis points. And then pause to see if those rate hikes will get inflation down to a percentage that the Fed is comfortable with. And that percentage is really 2%. Now, I don't believe we'll get to 2% in 2023. I don't believe that. But I think there's a good chance, guys, we could get to right around 3% by the end of December if things continue to progress like they've been progressing with inflation coming down, which is a huge win for our economy, right? Now, high inflation caused high interest rates. So when you look at your 30-year fixed rate mortgage rate, for those of you that are in the market to buy a new home like me, you're at 6%, guys, or higher, right? Think about it. January of 2022, you could have gotten a 30-year fixed rate mortgage for under 3%. So in a year and a half, mortgage rates have skyrocketed. And that really has cooled down the housing market. Now, prices for existing homes and new construction are still high because you got quite a bit of low inventory. But it cooled off the red hot housing market because interest rates became too expensive. The cost to borrow money became too expensive. And when that happens, it weeds out the people who were sort of like, okay, at 3%, I could afford a mortgage, but at 6%, I no longer can afford it. It weeds those people out. And that's what's happened. So demand in the housing market came down as the Fed started increasing interest rates. And you got to understand, guys, that was by design, though, right? Because one of the biggest drivers of high inflation was what? The red hot housing market. The Fed knew by raising short-term interest rates, it would cool off the housing market, and it did with those 6% 30-year fixed rate mortgage rates, right? It significantly cooled the housing market off. Now, when you look at the new car market and the used car market, it cooled that off as well. Because remember, prior to all the rate hikes, right around, shortly after the pandemic, I would say late 2020, early 2021, there was a supply issue for new cars, which did what to used cars? Drove up the price. Because if I go on the car lot and I can't get my new car because there are none there, the next thing I look for is a used car. And guess what? Used car prices went through the roof. But what has happened though since then with all these rate hikes? It's come down, right? They've come down. Why? Because to be able to buy a used car, a new car, most people have to go get financing. They got to go to a bank and get a loan. And back then, right, before all these rate hikes by the Fed, I was getting 7-year money. I'm talking about 7-year loan at 2% interest rate, fixed for the 7 years. Now you're at 4.5%, 5%. That's a big jump when it comes to being able to qualify for a loan. It's a big jump in financing cost, which a lot of times, again, weeds people out because people can't afford it. I could afford it at 2% interest rate, but I can't afford it at a 5% interest rate. So Fed has done exactly what they wanted to do to our economy from people going out buying stuff. They wanted people to stop buying stuff, and that's why the rates went up. So that's why you hear people talk about, why the Fed raising rates? That's why they raised them. Because they know eventually people wouldn't be able to afford to borrow money to buy stuff that they a lot of times don't even need. So yeah, the Fed, they know the American people. We're a country of spenders, right? We're a country of people who want to keep up with the Joneses. And when interest rates are low, people spend. People borrow to spend, right? When interest rates are high, people do what? They don't borrow. And they tend not to spend as much. That's why our economy has cooled off. The only thing really keeping our economy from really slipping into a recession is the red hot labor market. That's really the only thing keeping us out of a recession. Because the labor market itself has not cooled off as fast as the housing market, right? It just hasn't. And people are still able to find jobs. People are still getting wage increases. And as long as that's happening, people are still willing to spend money. They're not spending money from borrowing money to spend. They're really spending money from, trading time for money, and they actually get a paycheck and they take that paycheck and they go out and buy stuff. And what most people are doing is, since they don't really have an emergency fund, because that's a statistic we all know, 67% of Americans don't even have $1,000 in savings. So what most Americans will do is they'll use their credit cards as their safety net, right? So if I'm making $5,000 a month, but I'm spending $6,000 a month, I got $1,000 deficit, shortfall. So what most people do is they go get the credit card, and anything they can buy with that credit card limit, they buy. Whether that be groceries, gas, you name it, they buy it if they can use that credit card as that safety net. And that's what most people are doing. And that's why we have almost $1 trillion in credit card debt in the US. By far, we lead the world when it comes to credit card debt. But that's the reason why, right? And for a lot of people who are in that credit card debt, it ain't gonna be a good result for them at the end, because you gotta understand, with these rates, these Fed funds rate climbing up to 5% and soon to be probably a little bit higher than that, hey man, these credit card interest rates are tied to that. And they're variable rates, so they can move them anytime the credit card company wants to move them, right? They're tied to the Fed funds rate through what we call the prime rate. So banks borrow money from each other, you know, the interest rate, that's the Fed funds rate. But when banks lend money to consumers, they base it on the prime rate. And the prime rate is simply 3% higher than whatever the Fed funds rate is. So if the Fed funds rate is 5%, then prime rate is 8%. And that's what banks use as an interest rate meter to lend money to people. So when you look at your credit card, go look at your statement sometimes and go to the back where it talks about the interest and what your interest rate is. It'll give you a breakout of how they came up with that interest rate. And I guarantee you, somewhere in there, it'll say prime rate plus. So not only do they hit you with the prime rate, which is currently right now, I believe 7.75 or 8%, but then they add additional interest rate on top of that. Prime plus. That's where you come up with that 18, 20, 25, 27% interest rate on your credit card balances. So be careful if you guys got credit card balances out there. You better try to figure out a way to get those paid down, guys, because you'll be trapped in this cycle of never being able to pay the interest because these things are compounding constantly, right? But yeah, the Fed certainly did what it wanted to do. And I think by the end of the third quarter, we will see inflation in that 3% range. Right now it's 5%. I think by the end of the third quarter, early fourth quarter, it'll be in that 3% range. And at that point, the Fed won't hike anymore, right? Because the job has been done. Now the goal would be, let's not push the economy into a recession where growth completely stops, right? They don't want growth of our economy to completely stop. So they gotta be, it's a fine line that they're walking there, because if they can keep raising too high, raising, then all of a sudden, nobody's buying anything. That's not healthy for our economy either. That's why I'm telling you, 2% inflation is really the sweet spot. That's where our economy is the healthiest. That's where we have price stability and people, everybody has the opportunity to be able to buy the necessary things that they need to live when we're at price stability at a 2% inflation rate. Drop me some comments and let me know what you think we're going to end up at the end of the year as it relates to inflation. 4%, 3%, 2%. Let me know down in the comment box. If you want them 12 free stocks from Webull, click on that link down in the description box. Open up that new Webull account today. Go get that free stock. Go get that free money. If you're stopping by the channel for the first time, please consider subscribing, share the video, smash the like button. Thoughts become things. If you can see it in your mind, you can hold it in your hands. You guys keep chasing your greatness. Never stop believing in yourself. And I'm going to catch you on the next video. Peace. Today's video is sponsored by my company, RF Financial Consulting. And in my company, I work with individuals just like you through financial mentoring and coaching sessions. And in those 1-hour sessions, we talk about strategies to help you get to your financial freedom, whether it be through real estate investing, stock market investing, creating additional streams of income, credit card arbitrage, or starting and growing a business. If that's something that you might be interested in, there's an email address in the description box of the video. Send me an email and let's discuss if I'm the right fit for you.